Hey, welcome to the Capital Discussions Roundtable. I'm Tom Nunamaker with Jim Riggio and Dan Harvey. Before we get started, quick disclaimer, the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. If you don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And this is for educational purposes only. So this time I'm not going to stop sharing and switch screens. I'm going to switch to my PowerPoint slide. And
perfect.
All right. So we're here today to talk about the road trip trade. We've already gone through the disclaimer. And if you do want to download the slides, you can just use this link, cdurl.us/rtt slides, like road trip trade slides. I'll leave that up for a second if you want to copy it. And the trade was originally started by Dan Harvey, who's with us. And so just a big thank you, Dan. I actually took that picture of Dan when he was visiting us in Trier, Germany, near the Roman baths. So it's good memories of that trip, Dan. So thanks again for even sharing the trade and getting this whole thing started last year.
Well, that was a fantastic trip. We had a ball.
Yep, it was fun. The link, it's, let me just go up here, see if I can move this chat over. I'll put it in the chat. URL US. Okay, there's the link in the chat. Okay, so back to the slides. So a quick overview. We're going to talk about the trade goals, trade design, some guidelines, layering trades. We've been doing that recently. Reverse Harvey definition, and then we'll go through a few trade examples of a bullish market, a bearish market, and a few layered trades so you can see what those look like. And talk about any updates we have with our the service or the road trip itself. So the trade goals, 3 big priorities: preserve capital, not too many adjustments, and steady profits. So under the preserve capital, it's very unlikely to have a big loss, which is something iron condor traders can appreciate. And delta neutral, very low gamma, because we start these trades out fairly far out in time, 70 to 80 days. So the T+0 line is very flat, and low gamma is kind of close to a flat line. And normal exit is 10 to 15 days. If you are about the same, let expire, but the normal exit is our target, 10 to 15 days. We're monitoring for large moves during the first 11 to 21 to 30 days of the trade. Sorry, I had to close the door there. My wife's playing the flute. Timing of the entry adjustments isn't that critical. So we do have an entry window of, say, 70 to 80 days. And if you don't get filled on the 80th or 79th or 78th day, it's not too big of a deal. And then generally on most markets, you can just monitor it once per day. As long as the markets aren't making big moves, you can probably just check it, make sure everything's okay, and go about your business. And then profit target, we're trying to get 10 to 15% yield on our margin. If the markets are grinding up, that's going to be less, maybe 2, 3, 5, 6%. It won't be 10 generally. You can with layers and other things, but if you just do a standard reverse Harvey type of adjustments, then it's going to be less on the grinding markets. But the important thing is you're not losing, and you're not really fighting it that much. It's easy to manage, especially on grinding up markets. For the SPX, we're trying to enter 2 new trades every month. The Russell's only 1. We're doing just monthly for that because they don't have weeklies that go out as far. And it's easy to overlap multiple trades, and we do that to create kind of a basket of trades for the portfolio. And that actually works out very well if you have a big sell-off like we've had a couple times in the last year. The trade that you just put on in the last week might be in trouble, but the one you put on, 5, 6, 7 weeks ago is probably nicely profitable. So they all kind of average out and give you a nice portfolio. So the trade design we talked about, we do trade the Russell or SPX, and it's basically a put broken wing butterfly. And the normal entry for SPX is the upper long strike is normally within about 5 points of the current market. Doesn't have to be, and we placed it below that if we want to have more protection on the downside. Like, when the market was kind of going sideways for the last 30, 40 days, I think the last trade that you put on, Dan, was about 25 points below the market, just to give ourselves a little bit of an extra buffer.
Yes, I think so.
And the short strike, 40 points below the upper long, that's not hard and fast, but that's kind of generally what we do. And then the lower long is 50 points below the short strike. So it's 90 points between the two longs. And we enter, as we say, 70 to 80 days. Try and get on a flat to a down day so the volatility isn't hurting you. But, if it's a slight up day and the volatility is flat, then that's probably okay. You'd like to do it on a down day when the vol's up because volatility is mean reverting, and you're kind of helping yourself by entering the trade if the volatility is a little higher. The entry debit is no more than 5% of the margin. So this is something new from what we presented last January. And I'll show that in the example. And the reason we do that is we don't want to be too far away from the break-even line on the upside of the tent, because most of the time the markets go up and we tend to end up raising that. So if it's more than 5% below the zero line, it becomes harder to lift it to where it's profitable. So we want to be slightly below. That'll get us a little bit of negative delta at the start of the trade. But then, it's not that far away that we can't move it up easily to lock in a small profit on the upside. And the farther out you launch it, generally it's a little bit cheaper. And one of the philosophies we have is to be slow to adjust unless the market has a big move down. So a lot of people will see that we're only doing one reverse Harvey, and we're spreading them out, and they say, well, why don't you do more? Well, that creates more positive delta and gives you more risk of a bigger move down right away. So we try and slowly administer these adjustments. And the adjustments, if we do have a big move early in the trade, before we were just buying a long put, but we've kind of switched that to a long put debit spread. You can exit too, and those are usually the choices that we'll have. But there are other alternatives you can use, and we'll go through that later. And normally, if it's later in the trade, you probably have a profit. So if you have a big move down, it's usually best just to exit, take a profit, and move on to the next trade. The guidelines, we're using about $15,000 of capital for a tranche. Tranche is French for slice, and that's basically like a unit, if you will. So one tranche or one unit is approximately a 10 lot. It depends on your strike width. So if you're using a 40-50 strike width, then that's about maybe an 8 or 10 lot. And if it's farther, say a 50-75 or 75-100, it might be a 6 lot or a 5 lot. You just have to play around with it. And profit target is about $1,000. It's what we like to get per tranche. So you're looking for trying to get around 7% on average. The initial put broken wing fly, like we said, uses a 40 or 50 strike width, and that's a ratio of approximately 0.7 to 0.8. And you can extend that to larger widths. So if you want to have more room, you can make, like I said here, 50-75, 60-80, 75-100, et cetera. As long as you have about that 0.7 to 0.8 ratio, that's going to give you the approximate shape that we're looking for. And then we'll show you in the example that if your ratio is off a little bit and that debit's too high, we'll show you how to fix that with the Reverse Harvey. Something else that's new from January is we're using conditional orders for that long put debit spread. That's a protective defensive measure on a market move down. Generally put it around the short strike, could be a little higher. And if you want to be more conservative, you can even increase that trigger point a little bit higher than that. Let's see. And optionally, you can use teenies, the 1 or 2 delta puts. We don't do that, but some people do like to add those. in the first 21 to 30 days of the trade, we try and leave it alone and just kind of let theta start doing its job. But we do have to monitor it for large market moves, and that's kind of the time the trade is most vulnerable to a big move down is early on. So that's kind of the most critical time to monitor it, but you try and keep your hands off it and leave it alone. And after the first 30 days, so if the market has run up above the tent, there's some things we can do. Reverse Harvey by rolling down the long put to lift the expiration. So you're essentially adding a bullish vertical spread. And like we said earlier, it's you do this slowly. So you don't want to reverse Harvey too quickly, again, because that increases your risk if the market declines. As time passes and the trade's safer, then you can keep reverse harving until the premiums start running out of juice, and it doesn't justify the increased reverse Harveys. To keep margin from increasing, you can do reverse Harveys both ways on both longs, so you can basically roll both longs in towards the short and keep the margin fairly close, and you don't have to really increase the margin by doing these reverse Harveys. So you'll still raise the expiration upside, and you'll keep the margin about the same. And when you do reverse Harvey, you do lower the profit potential in the sweet zone. So if you want to try and leave the trade in play, is the market does frequently pull back. So that's one reason not to reverse Harvey too quickly, because if the market does come back, you want to have that lift above the expiration line to try and get some extra profits out of it. And this is a good note. Once the trade is up around 10%, you can reverse Harvey, partially or fully exit the trade to lock in profits and keep reducing risk. And the reducing risk is kind of the big thing with here is we don't want to take big losses. So we're always trying to keep the risk under control. If your conditional order is triggered, you want to record the price that you paid for that debit spread. And then when the debit spread, I put in a good till cancel order, but if it gets to 50 to 75% of what you paid, you want to close it. And that keeps the cost of that spread reasonable if the market whipsaws. And you just put a GTC order and it'll take care of itself. If the market continues lower, you can add more of them, more put debit spreads or exit. You can do some other things we'll talk about later, like adding a long put or even some short ETFs. Or you can reposition if you have enough time. Let's see, if the market is below the tent, you have to really closely monitor your profit and loss. And if it doesn't return to the tent, it's usually best to close the trade. And I also added, if the market moves down below the tent very quickly, like a big move, like some of the moves we've seen, it's usually best not to hang around and see if it's going to come back. It's, if you're below the tent after a huge move, it's up to you, but don't, it's better to exit with a small loss than try and, beat it over the head and then end up losing a lot more. So the normal exit, like we talked about, is 10 to 15 days to expiration if the market's near the tent. You can take it into expiration if you're well above and the risk is low. You can close the trade if you're at or near the expiration profit, as well as above the tent to free up the margin if you need it. And generally, we tend not to close those trades. We just let them expire, but you certainly are able to do that if you want to. And this is something new from January about the layering. So Dan's been adding smaller butterflies or other types of trades to try and lift the T+0 line and try and get more profit out of the trade. So if the market's above the tent, that's the time you want to start thinking about layering. And most trades are suitable, but you want to keep them small. So if you have, say, a 6 or a 10 lot, you might want to do a 1 lot butterfly, for instance. So it's we would call like a baby butter. And then just adding the small butterflies just above the tent can really boost your returns with very little increase in margin. So before we talk about some examples, for those who don't know what a reverse Harvey is, let's just go through that quickly.
Most of our subscribers like to maintain a fairly constant margin requirement, so we usually do it on both sides. both on the upper side of the tent, which is basically tantamount to doing a put credit spread, and also on the lower side of the tent, which is the equivalent of doing a put debit spread. And this will maintain an approximate margin equivalent. And these don't have to be done the same number of contracts. And what I usually do is set it up as a condor type of order, because it makes it easier to send out on the alert service, and they're usually filled very quickly.
Basically, the structure of a reverse Harvey is we're going to sell long options and buy replacement longs closer to the market price of the underlying, or in our case, closer to the short strike of the butterfly. So when we're reverse Harveying above the tent, it's going to be a credit, and it's a bullish adjustment. So it's a bullish vertical. You're buying a lower put and selling a higher strike put. The reverse Harvey below the tent is for a debit and a bearish vertical. So it's buying a higher strike put and selling the lower strike put. So you normally do this after you have a profit in the butterfly, but you can also be used with most option spreads, say like iron condors or even symmetric butterflies or an M3 or almost any spread type of trade. And what happens when the trade evolves over time, the premium starts shrinking. And what you'll see is a lot of the strikes, the prices start getting really close to each other. So you might have a 10 or 15 or 20 point spread, but the difference in the option prices might collapse down to 10, 20, 30 cents. So what you can do is you can roll up those lower longs for just pennies and cut your margin and not really give up too much of your profit. So it's a nice technique not only for the road trip trade, but for any option spread. And okay, in the last bullet, we can use it to reduce margin or raise the profit of the P&L curve. And let's see if I can get to my next.
That one's my favorite, right? I use it. I use it a lot of times to end up reducing margin. It's a wonderful trade if you think about it, right? You're not only getting your deltas adjusted, but you're doing it and you're taking margin off the table that you could use later on.
Absolutely. So what kind of reverse Harvey? Well, the SPX is above the tent. Reverse Harvey, the upper long, is basically you're just lifting that upside part of the curve, and you can reverse Harvey the lower long, like Dan said, and we do that in the alert service. But if you have a PM account or you have lots of extra margin, you don't have to. It's fine just to reverse Harvey the upper long by itself. You just realize it's going to increase the margin in your trade. If the SPX is in the tent, we tend to do both longs because you want to keep it more symmetric. And then I did write an article about the reverse Harvey on our public site. If you just go there and just search for reverse Harvey, you can find it, or just use that link directly. So let's go through a quick bullish example. This trade started March 7th. It was the May expiration, the monthly cycle. And we're using, looks like 45 and 55 strike lists between the 1975, 1930s. So we'll just try this. Here's what the Greeks look like. But let's see on the graph that the debit is actually 12%, which is a bit too high. Remember, we're trying to keep it under 5%. So because it's a little bit lower, then it gets harder to raise it up if you start it this way, if the market grinds higher. So what we do is we'll reverse Harvey that upper long, the 1975, and just move 3 of them down 10 points, and you can see on the trade column in red. So that leaves us with our new position on the right. And the Greeks, we're not quite as negative delta, but all the Greeks, the other Greeks are fairly similar. The margin's a little bit higher. And now it looks like this. So now we're only 3.6% of the margin in use, which is about what we're looking for. So you can see it's closer to that expiration zero line. So when the market does run higher, it's going to be much easier to lift that side of the trade up and lock in a profit. So let's, on this trade, let's just fast forward a month, not too much happened. The market went up about 42 points or so, and the trade was up about $230 or 1.7%. And it looks like this. The probability of touching that short strike is about 17%, and the 2 standard deviation lower bound at T plus 28, which is 15 days before expiration, is well inside the tent, so it's looking safer and safer to do the reverse Harvey. So let's go ahead and do that and see what happens. So here we reverse Harveyed 4 of the upper strikes, we moved those lower, and we moved up 3 of the lower ones. And the margin increased just a little bit from 13.9 to 15.3. And the other Greeks are fairly similar. Theta decreased slightly, Vega increased. But let's see what that does. It did lift the expiration P&L above the tent, and at this point it's positive 186. So as long as the SPX stays above, 1980, you're going to expire at a profit. But if you notice those blue lines, the dashed lines above it, there's still positive theta in the trade. So time is still working for you, but the family of curves is a little bit compressed where the market is. But if we pull back, there's still some nice profit potential. So we're not trying to reverse Harvey too quickly. We could lift it up even farther, but then the curves would flatten more, or even maybe go down. Hang on a second. I'm going to have to unplug the phone.
Tom, while you're doing that, one thing I would point out is that we initially had some feedback from our subscribers that said something, who would say something to the effect that, hey, Tom, hey, Dan, you have a lot more different strikes than when you started this. You have more strikes than the usual butterfly. And yes, we do. And that is actually a part of the strategy. So we tell everybody to become familiar with looking at the matrix basically as an inventory of trades rather than trying to, retain the basic butterfly configuration. Because once you've done a few reverse Harveys or maybe added a put debit spread, the graph will still look like the usual butterfly configuration, but if you look at the matrix, of course, you'll have several strikes. But this is never a problem because it's easy to get out of the trade when you need to.
Right. And just one thing I always like to think about when I'm making adjustments is you notice that the before adjusting versus the after adjusting tent is smaller. So you've given up this profit potential, but you've essentially shifted it over here and basically moved all this profit over here and lifted this line up. That's one way I like to look at it. But you can see this butterfly itself is shrinking, and to do that, it's lifting up this side. So that's one way to kind of look at how these adjustments work. So 6 days later, the market's up another 40 points, it looks like. So the trade's up $450, up 3%. And looks like this. The family of curves is compressed. And what we mean family of curves is these T plus N lines. So T plus 0, 10, 20, 50, whatever. All these lines, here they're nice and separate, but as you go up, they're getting closer and closer together. And here there's essentially just one line. So it's getting compressed. So let's do a reverse Harvey on both longs, 25 points again. So we're going to just take off those 1975s and move them down and just move up the 1875s to 1900. So if you look at it, this was 942 and 710, so that was $2.32. But the lower side is less than $1. It's about 90-some cents. And the margin is, again, about the same. And we did three on each side. So it looks like this. So again, we're basically shrinking this butterfly and taking this and lifting it up more. And now the upside P&L expiration is up $654. So we're just ratcheting this up as the trade passes in time and becomes safer and is farther away from the market. And you notice that the T plus 19 line is definitely moving down when you do that. So you're giving up potential profit if the market pulls back, but you're locking in a profit, a little bit higher profit at expiration. So it's kind of it's a balancing act. You don't want to do it too fast because the market does pull back. You are giving up some potential profit, but the longer you wait, even this will start shrinking. So you have to kind of make a decision. Where do I want to raise this up versus giving up some profit potential? What's the likelihood of it actually coming back here and getting some of that profit? So that's kind of the art of it. And Dan, any observations on the reverse Harvey process and how fast or slow we do it?
Well, actually, no, I would agree with pretty much everything that you said. Slow and steady wins the race as always, and people, many people tend to forget that, number one, we're not really making money. Pardon me. We're not really making money on the spot when we're doing a reverse Harvey. We may be receiving a credit for the trade, but we're not really making any additional money. But we are raising the lineup, the expiration lineup, so that a theta decay does not have a negative impact on the trade. But in so doing, as Tom mentioned, we are giving up some potential profit that would have been intrinsic to the butterfly structure. And this is the main reason we don't want to do this too quickly, because we, here in the United States, there used to be a saying during the Reagan years, let Reagan be Reagan. Well, we are letting the butterfly be the butterfly for as long as we can, because we would like to have some butterfly action on the trade. But if we have a sustained rally, the advantage of the road trip trade is that we can still make some pretty good money, even if we have a sustained rally. So that's all.
And I personally like it when it's up like this, because I can check the markets and see if it's up or down a few dollars. I just don't worry about it. So, at this point, we have no risk on the upside. So the market can rally all at once and you sleep really well at night, which I like that a lot. But anyway, that's this slide. And here's your new profit zone. Because we've lifted that upside expiration line above zero, there is no risk on the upside, and you have a massive zone for making money at this point. And I like that kind of profit zone personally. So does my wife. So 1 week later, we reverse Harvey one more time. Profit in the trade is up to 503. Again, margin's about the same. And again, we're kind of shrinking this butterfly tent over here to lift the line up a little bit more. So we've lifted it up now to 700. And this is basically, I think, where we're going to let it go. And then we just wait 15 days to expiration and take the trade off. It made $765 and up almost 5%. So that's a typical trade on a market grinding up. You're just slowly lifting that P&L line up above the tent. And here's what the market did during that period. So a typical grinding up market. And trade worked out pretty well. So that's an up market. Let's take a look at a bearish market. Now, this is probably about the worst time to put a road trip trade on, is immediately after you put the trade on, the market starts selling off. And that kind of happened in January. If you remember, we had a pretty big sell-off in January. So I picked this entry for a March road trip, which is right at the end of December. And actually, I put a live trade on in my own account about this, I think, the day after. So this is actually fairly close to my own account. So if we started with a 50-70 split, then 12,700 margin, and the trade looks like this. So it actually worked out pretty well. We didn't even have to reverse Harvey this upper long, because we're already starting at a 3.8% of the margin in use for our debit. So that looks like a fine entry. So let's talk about a conditional order. And we started doing this since our January presentation, that use a trigger point near the short strike, maybe slightly above, and you can set that higher if you want to be more conservative. Once the trigger price is hit, you can buy a put debit spread. And Thinkorswim has a nice feature that you can give the market makers 10 or 15 cents off the mid price, and that should give you a pretty high probability of getting filled. Any experience on that, Dan? Have you had any problems getting filled on those conditional orders?
No, I'm filled very quickly. I may have to give up a nickel, sometimes a dime, but I'm generally filled very quickly. unless the market is moving really fast, then you have to give the market maker a little more. But otherwise, no problem.
And then for those of us who use interactive brokers like I do, you can't give the market makers that extra 10 or 15 cents. So you can only put the order in at the mid price, which doesn't guarantee you a fill, and you actually might not get filled. So what I do as an alternative is, sorry about my VPN there, is to short SPY at the trigger point to flatten the position. So once I do that, then the position is basically close to zero delta. Then I can go in and put in my option trades, and once those are filled, I can take my SPY hedge off. So that's an alternative way of flattening the position and giving you time to put in whatever option order you want and try and work a good price. So for this trade, we'll set the good till cancel order at 2030, which is 50 points below the XPS price. And if I go back to the risk graph, that's right here. It's just a little bit above the short. So that's where we're going to put the conditional order. Unfortunately, the market had a massive move down. Let's see where it started. It started at 2080. And here we're at 2012, just a few days later. I think it was down like 30 or 40 points. So the market opened about 18 points below my trigger point. So I just put the order in and got the fill. Now the one nice thing with these put debit spreads is they do reduce your margin on the trade. So that's one nice thing. So you're taking off risk on the downside. What you want to do is you want to note the price that you paid. So in this case, $79 minus $60.05. So I paid $19.25 for the debit spread, and I'll just use 70% as my good till cancel price to buy it back. So I would put a GTC order in to close that spread at $13.50. And the reason you want to do that is if the market whipsaws on you and shoots back up the other way, you want to get that closed and not give up too much of that hedge price. So in that case, I would be giving up less than $6, so $5.75 or something. But if the market keeps going down, that spread's going to keep gaining in value. So the only time that should ever get filled is if the market whipsaws against you. And you can see the delta after you put that spread on is now negative, and all the other Greeks are fairly close, but we're getting more negative delta, which is what we want in this case. So the option view T plus N lines are really messed up. So I'm not sure if this is even right, but this is where the trade was after I put that debit spread on. And let's go. Let's see. I think 2 days later, the market's approaching the edge of the tent. We're already down to 1988. So this is almost 100 points below where we put the trade on a week earlier. So we're going to add one more put debit spread because again, we're near the bottom edge of the tent and market's just falling, so we're going to try and defend it one more time. So we have our debit spread number one. The first one we put on is here, and there's our GTC order to close. The number two one was also 1925, and we're going to also put in an order to close that. And you notice the margin required is now 6,800. Now I used 12,700. This is the max margin used in the trade for calculating yields and all that, but at this point, the margin is really reduced under $7,000. So even if we had a black swan event, the most you could lose on this would be under $7,000. And that's another nice thing with the put debit spreads. It really cuts the risk down if you have a catastrophic loss or a catastrophic move down. So you can see that this is the margin being reduced right here, and it's flattening out the lines. So we're trying to hang in there. So we'll just make sure the market doesn't run away from us and just keep killing our account. The next day, the market was below the tent, and normally if something like this happens, we're 116 points below where we started just about a week earlier, 6 trading days. To me, the market's just out of control, and if I can exit, like in this case, with a $230 loss, so be it. That's peace of mind. You don't have to worry about it. And what the trade looked like was like this. And I remember Jim Cramer, he had a position that his wife sold when he went to the bathroom, and he came back and he's like, why'd you sell it? And she was like, well, if you like it so much, put it back on. I said, I wouldn't put that on. So, ask yourself, if you're in this position would you put this trade on like this today? And I wouldn't. And, so I can exit here with a small loss, which is, again, part of the road trip trade to keep the mathematical expectancy high. And there's still 71 days left in the trade, so there's plenty of time to reposition it if you want to and re-enter. But, at this point, the trade is not really looking like a road trip trade, like it should. So just exit the trade, get your small loss, and then move on to the next one. Any comments about that, Dan? I think that's one of the key elements of the road trip trade, really.
You're exactly correct. That is one of the key elements of the trade because we are looking for a good positive expectancy, good Sortino ratio, and the other metrics that we use to evaluate, how we're doing. And like any other type of trade, if you start taking big losses, it doesn't matter if you have a 20% winner, if you have a lot of 15% losses, because by the time you add them all up, the results are not going to be good. So I would have done exactly what Tom said. This is the point to simply wave this trade goodbye. And since there is quite a bit of time left, what I generally do, and I think Tom does the same thing, probably Jim too, on what he does, is to wait a while for the market to show evidence of stabilization and then see what kind of prices you can still get and then make a decision on whether or not to reposition the trade.
Yep. And I, if I didn't have a trade on, I would not put this trade on. So that's a good clue for me to just get out. And I think this is an example of, okay, we did lose money, but it's not that much. If you were an iron condor trader, you'd be down big bucks because the market was up here at 2080, and 6 trading days later, it's down under at 1960.
You'd be toast.
So that's a pretty big move.
Dan, I do exactly the same thing. You and I have spoken about this. Some of the greatest trades we've ever made were for small losses.
Right. Exactly.
It's like my 8th grade teacher used to say, the only questions you tend to remember on a test are the ones you got wrong. So the trades you tend to remember are the trades that you lost money on. And you can see this is the sell-off that we were fighting against. So coming out with a $200 loss is pretty nice. I'd be happy with that. So the debrief, I like this picture. It was from an RAF bomber crew in World War II. They're debriefing it, so I just had to put that on there. So in the 6 trading days after entry, the market was down 116 points. Implied volatility went from 13.2 up to 21, so a 60% increase in vol in 6 days. The loss was small due to the debit spreads, and the speed of the market wasn't at black swan level. So what I mean by that is if we had a 1987 type of crash where you're down 22%, you're going to lose money on this. But the nice thing is if you go back here, if we do go down 22%, we're going to be at this line. So you're going to be down under $7,000 at this point. It's not really going to cripple your account. So that's one nice thing with the debit spreads or even adding a long put is you're lifting up the damage if you do have a major black swan type of event. So back to this, and like we said, there's still 71 days expiration, so we can easily re-enter this trade once it's stabilized and set up a nice new road trip trade and have a good chance of recovering that loss and then some. So we want to reduce the vega or make it positive if the market continues lower, and the debit spreads do that. Put credits or put long puts do that as well, and getting slightly negative delta will also help. And again, you don't want to stay outside of the tent on the downside too long. So if the market is moving slowly and more controlled, maybe you have a few days of plus 10, minus 20, plus 10, and you kind of drift outside the tent, then you might want to give it a few days to see if it's going to rebound and come back. But if it's a big move like that, 116 points in 6 days, personally, I don't like fighting that strong of a move. So that's, for me, a sign to just get out. And I've back tested different things, and usually exiting is the simplest and often the most effective thing to do. Okay, so we talked about all the things on this slide. So Alternatives to the put debit spread, like we said, you can do a long put. Some of the pros, it's positive vega, which helps, and negative delta. It's very effective on a continued down move, and it's easy to put on. The problems are it loses value every day because it's negative theta, and if the market reverses, the volatility will come out, and the put was going to lose value very quickly. So you might not get a good price when you buy your long put in a fast market as well, because the slippage can really increase. And short ETF or short futures, I tend to do this. It's extremely quick to get on. In fact, I did this on Friday about 5 minutes before the close. I shorted some SPY in about 8 different accounts I trade, and it was like boom, 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 boom. You don't have to wait for the options to try and get a fill at a mid price. You know, the spiders have a penny wide, so I just do market orders and I get filled, so and then move on to the next one. And what that effectively does is it rotates the risk graph a little bit because you're just using pure delta when you're doing that. Market makers do this all the time. They just buy or sell the stock to adjust their Greeks. So you don't have any other Greeks fighting you. Like, you're not giving up theta. You're just using delta to adjust it. And you can use it to buy time to get your option defense in place. So basically, you short your ETF for futures, and then that gives you time to put on your options and then take off the ETF for futures.
Tom, you had mentioned that professional traders use that. In one of the professional trading platforms that I ended up using called Obsidian, there was a flatten button. And what the flatten button would do is exactly that. It would buy the number of shares you would need to end up getting to get your deltas to be flat. It left all the other Greeks intact, right? It didn't change any of the second derivatives, the theta, the vega. All it would do is buy or sell the underlying, so you could end up being flat. And I know a lot of professional traders used to use that when markets would move quickly. They're like, I don't want to end up having to deal with this right now. Let me be flat. It's a very effective way if you need to end up getting something done and done now.
Yep. The bad thing is it's basically a straight line, so there's no gamma. So as the options risk line is kind of curving down and gamma is increasing and changing, this hedge isn't. So you have to keep adjusting the amount of short futures or ETFs that you're using if you want to maintain that delta neutrality. And it could be restricted in an IRA. So those are about the only negatives of it. But that is an alternative. And again, with interactive brokers not being able to add price to the midpoint on a conditional order, to me, this is what I use for neutralizing a trade on a conditional order. So that works out pretty well. So let's talk about layering trades a little bit. Dan, maybe you want to talk a little bit about the layers. I know you started doing this a few months ago, and it seems to be working out pretty well.
Sure. I started thinking about, well, we both did. It was not just me. We both started thinking about what can we do if the market continues to grind up. Yes, we're doing the reverse Harveys, and that is raising the tent and increasing our likelihood of profit. But what else can we do? So we started thinking about, adding a layer, and we didn't want to increase the risk very much, and we didn't want to increase the margin very much. So basically, we wait for the market to be a sufficient distance, and this is a judgment call, for the underlying to be a sufficient distance from the upper long put, and then we are going to add a small layer. And what can the layer be? Well, my preference is a small lot broken wing butterfly, a 1 by 2 by 1 as a rule. And I try to position it such that the short strike is a little bit closer to the current market than I would usually do for the initial trade launch, because I want this thing to start generating some good theta if we stay within range. And as Tom will show, when this graph is superimposed on the big butter, the mama butter, the thing just looks great. And I have sort of likened this to the old game of Tetris, where I don't think they had any triangles, but if you can imagine simply dropping in a triangle, And when Tom shows it, you'll see what I'm talking about. So that's my first choice. You can also simply add some put credit spreads, and you want to place those far enough, away from the market that you're not too likely to be hit. And you can even do an iron condor, like you could, for example, sell 2 put credit spreads and sell 1 call credit spread. This will balance out your Greeks and will give you a good looking graph and will increase your expected return.
Yep, and like it says on the last bullets there, ask yourself, is the possible profit worth the extra risk, and is there enough time remaining to justify the trade risk? So those are the questions you have to ask yourself when you're thinking about layering. And here's just a couple of examples of some recent trades with some layers. I think some of these are actually open. So here's the big butter on the left and the layered butter on the right. So it creates that little tent next to the big one, and it's lifting the T plus N lines up nicely. So this has a really nice profit zone. This gives some nice extra profit potential. And another one, this is I forget which expiration this one is, but this one looks great too. And you can see it's again the butterfly shape. The last one I'm showing is, I think, was this an iron condor that you layered on, Dan?
Yes, I think so. Yes, it was.
And you can see that one worked out great as well. So those are some of the layers that Dan's put on. I see there was a question in the chat about the returns. On the accounts that I'm trading, I'm getting about 25 to 30% so far in the year. And I'm usually in the trade until close to expiration. Not always, but probably typical trade is in about 55 to 60 days. So that was that. Let me see what else we have for the presentation before we go to questions. Oh, so we do have the road trip trade alerts that Dan and I are running. And it's basically, Dan, I think it's your IRA that you're doing. It's live trades that you're putting on in your Thinkorswim account.
Yes, right, exactly. I chose to do this in one of my IRAs, one of the ones that I have in the Thinkorswim account, because it's obviously Reg T. So, whatever I'm showing for margin is Reg T margins, which would be equivalent for the subscribers. I also do this, of course, in a PM account, and I trade that a little bit differently, as you might imagine, but they're very similar.
And when Dan puts these trades on, we do send them out in real time via email and SMS with like all of our trade alerts. Like Jim runs the Kevlar service, and we have all the same back end. So you can choose how you get them. And we do SPX and Russell, and then you get all these trade messages, images, forums, blah, blah, blah. And you can get more information at roadtriptrade.com. And questions. I noticed Ron had a point about shorting SPY stock. It can potentially have large Reg T margin. I'm doing it generally in my PM accounts, but I do have some small Reg T accounts that I trade. But fortunately, you don't need to short that many shares. I'm adjusting like 5 or 10 SPX deltas for those accounts, which is not too many. It's 10 to 1 on the SPY, so I might be selling 40 SPY to short 4 SPX deltas. But definitely can have a Reg T problem if you don't have enough margin. So the shorting the SPY stock could be a non-starter for some people, especially in IRA accounts. Let's see. What other questions do we have, Dan? Yeah, Mukesh, you can download the presentation files. I'll just put the URL in here again.
We've had a few questions of what other vehicles might this be used on. And this actually can work on liquid, high premium stocks. It's a little trickier, but it can work. I've tried this a couple times on crude. I wasn't really, CL futures options, wasn't really happy with that, but I know it will work on ES options. Your commission costs will be higher, but that does give you using ES will give you some additional choices for any sort of hedging procedure. Let's see, Tom. I suppose on some Forex things, I have not personally done this, but I think it will work.
Yeah, you should be able to use it on futures options on Forex. The problem I've had with Forex in the past is you can get central bank announcements that act like earning events, and they can come out of the blue. Like, remember when the Swiss bank depegged its currency, and the Swiss franc dropped from 1.2 to 1 in like a heartbeat? So nobody predicted that, and that would be almost like a black swan type of event. So I tend not to trade the currencies with futures options lately. You can trade some of the foreign currencies or foreign indexes, say like the DAX or the Eurostox 50, which are very liquid. I don't know if you can do it in U.S. accounts though, but those who have access to it could certainly trade it. And I think any liquid stock would be able to. I would just be careful around earnings and make sure that you're nice and flat and wide. I see a question from Anthony. Hey, Anthony. About thoughts on the road trip trade going through potentially crazy events such as the next week's Fed meeting. I personally closed all my trades before Brexit because I thought that was more like an earnings event for the market. And Dan didn't, but he got through it. Had a few losses, but nothing catastrophic. So you can definitely trade through them. If you're worried about it, you can always close the shorter ones if they're anywhere near the tent. But if you have some room on the downside, you can definitely trade through them. And it also depends on where you put your strikes. If you start out with a 75-100 strike width, then you're going to have more room and protection versus somebody who did a 40-50, for instance. Any other thoughts on trading through like a Fed type announcement, Dan?
Well, I usually will go through a Fed announcement because they're fairly frequent, unless the trade is already in trouble. In hindsight on the Brexit, obviously, I would like to have that one back. Like I suppose many other people, had a head fake, in the sense that, head fake in the sense that everybody thought that Great Britain was not going to leave, and the market reaction traded accordingly, and then lo and behold, everybody got faked out, including me. So I'd like to have that one back. But otherwise, unless it's a major event like that, I usually stay in these things. And I've noticed we've had a few, just to change the subject, we've had a few other comments here about other types of instruments and certain kinds of commodities, and those comments are all true. For this trade to work, you need to have a reasonably linear volatility, reasonably linear type of skew. You don't want something with a lot of blips and humps and bumps in the smile curve, and that's actually, I think, the reason why crude does not work well on this. But for some of the other commodities, and certainly the ES futures, it would work. But you would want to look at your the volatility smile, and if it's such that there's a lot of bumps and humps, you're not going to want to do that one.
Okay, looks like there were a lot of questions, but I think we probably covered most of them. Are there any questions that you see, Dan or Jim, that we didn't answer?
No, most of them were about different environments. Okay, there was a good conversation about put skew and how Brexit was different. I posted that chat or that in the forum link, and then it was mostly around different instruments. What I'd say about different instruments is that you're really better off trading an instrument that you really know it well. And I'm not just talking about its price movement, but I'm talking about how the options and the implied volatilities end up changing. Is it more of an event type risk, like an earnings, like you talked about, and that's what a lot of times the Fed looks like, or is it more where they're fearful of just protecting against the end of the world, the way it was with Brexit? And to be able to end up measuring, right? You have to be able to end up taking a look at it and having some way of being able to end up measuring. Dan and I, and back when we traded with Steve Channon, we used to end up having those conversations all the time about how to end up protecting what part, where volatility was. And so you really have to get to know your underlying is the only thing I'd say on that.
I see we have a couple of questions that we didn't answer. Ray asked, do you ever Harvey half or all the initial shorts on an extended move up? I think John Locke does that on M3s, but we tend to leave that initial short in place. I haven't seen us ever move it, Dan.
No, I'm always afraid of a whipsaw, so I don't like to do anything too drastic. For example, just the most recent few days, volatility has kicked up. If you look at any of the usual measures of volatility, obviously the VIX, but also the VVIX and the VXST and the VXV and the other measures of volatility, they've all kicked up. And what that usually means is that you're going to have some big up days and you're going to have some big down days. So when you're sitting in a position, you're very likely to be whipsawed. If you do anything radical, it may very well come back to bite you. So I usually don't do that. I'm not a big cut and roll kind of guy. Back in the early years of my trading, when I did basically nothing but condors, naturally I did a lot of cutting and rolling then, and I think I got it out of my system.
I'm in your camp, Dan. I'm older. I don't want to have any drama in my trading.
Right.
There was a question about do we ever use directional bias to enter the trade, and I do by the two things that I do is I'll either widen out the strikes or start with the upper long put farther below the market, and I tend to like the 25-point strikes because they seem to get filled a little bit better. But that's how I do my directional bias. If I think the market might be a chance of going lower, I'll either widen it out or start lower or both.
And I do something very similar. I definitely start lower, and I usually widen it out, and I try to get at least two legs at the 25 multiple strike. As many of you know, when we've discussed this, the lower long put is often referred to as the garbage put, and that is basically needed simply for margin considerations. Otherwise, you have a ratio spread. And so simply by adjusting the lower long put, you can determine the cost of the butterfly to an extensive degree. And so I usually focus on the upper long put and the short strike, and I'm very careful about where I place them. Then I look at the lower long put to try to make it a cheap butterfly without downsloping the curves too much.
Let's see. Chris asks, how wide are the extra flies? So the layered flies that we add. What kind of strike widths are you using? I can't remember off the top of my head, Dan.
Oh, that's a good question. Yeah, they're narrower, so they might be 30, 40, something like that. They're usually narrower, and I try to drop them in so that they either directly drop in the slot, so to speak, left. That you see the slot between the upper long put and the current market, like that. So I either drop them in, or in this example number 2, I will superimpose them. So you'll want to wind up with something that looks like either number 1 or number 2.
Okay, and then Rakesh asked, have we tried the road trip with ES options? I haven't. Have you looked at ES options at all, Dan?
They They seem to work okay, but of course you pay more for the commission costs. But yes, they generally will work okay. But you have to change up. Well, as you might imagine, you have to change up the spread widths, everything to make it still look like a road trip style trade.
Having the 10-to-1 ratio, the SPY to SPX versus the 5-to-1 ratio, the SPY to the ESs, that always messed me up. I'd rather just stick with 10-to-1. The math worked a lot easier. And there's no tax reason to end up doing it. You still have 1256 contracts on both of them. And Dan, like you said, probably the best reason besides just being confused is that your commissions will be half.
Right.
Jack says, is it a good idea to layer after Reverse Harvey or before? Does it matter? I think generally the layering happens after Reverse Harveys.
Yes. Sometimes we will do them in fairly close proximity, maybe within a day of doing them. But generally, we start with the Reverse Harvey, and it will usually become apparent of when the trade would be able to handle adding another small layer. So it's usually not a difficult decision.
Let's see, Dirk asked about portfolio margin guidelines. What I use on the accounts that I trade, I use about 40% of the PM margin available for my road trip trades. Reg T, I'll go to about 80%. And then as far as holding different strategies, I'm just trading road trips all in SPX. So when I do those debit spreads, I'm looking at the whole thing in option view as a whole. So I see what my total portfolio delta is, and then I know how much I need to buy to hedge that. And then as far as margin increases, the nice thing with the put debit spreads is they decrease the margin. So you never have to worry about margin increases when you're doing the hedge. And then Andy asked any advantages, disadvantages of SPX over Russell. Personally, I think SPX moves a little bit slower than Russell, so I like that. What are your thoughts, Dan? It's also more liquid.
Right, it is more liquid. I think it's an easier trade. We do offer the road trip trade service on Russell because I think some people wanted to be in this type of trade with lower margin with lower capital requirements. That's one of the reasons that we offer it. And we only do it on the monthly cycle, so we only have one a month. So we offer that for people with perhaps smaller capital allocation. And the trade is profitable, maybe not quite as profitable as the SPX. But I think it's worthwhile doing. But the fills are a little more problematic. You really have to work your trades for getting into Russell. Whereas with the SPX, you give the market maker a nickel or dime, maybe 15 cents, and they're happy.
I think the summary is, okay, where old people like slow, the SPX is slower than the Russell.
Also, a friend of mine who's running a pretty good sized fund. He was his first Russell trade. He was trying to do 1,000 lot, and I think it was an Iron Condor. He says the Russell has no liquidity. He's like, what do you mean? Well, they won't fill my 1,000 lot. But on SPX, I think you can probably get it filled easier than on the Russell.
You definitely can. You're trading against a lot more bots on the Russell also.
Yeah. John Porter says he uses ES and likes it a lot. Anthony Banacasa. Hey, Anthony, thoughts on hedging with a backspread strategy?
I already answered that. For those of you that don't know, I had worked with another investment firm where we actually built hedging strategies, did it on the S&P, and they turned into 2 mutual funds. It's written up in some of the chats. But yes, I'll do a separate WebEx on hedging. It's too big of a topic to end up adding to the end of this one.
And Mukesh asked what sort of short delta for the extra flies a layered. I think it's in the presentation. It's around 25 to 30 generally. Let's see what else. Looks like we're about out of the questions.
I think we got most of them.
Yeah, that's good. All right, so we're a little over an hour, but lots of good questions, and thanks Dan and Jim and everyone for joining us. Really appreciate it. And I do have one final slide.
How about the alert service? They're asking how do they end up finding out more about the alert service?
Oh, just go to roadtriptrade.com. I'll even put it in the chat for everyone.
Well, that was an excellent presentation, Tom. That was really well done, and you know, great slides. Much better than I would have done. You know, frankly, you know me, I would have had a lot more jokes and would have wasted a lot more time. And I would have had more funny pictures. But you did it great.
Well, I didn't get to bed till 10 in the morning finishing up the slides, so I didn't have time to put in more funny pictures. But I will.
Well, it's better not. Yeah, it's better not to. Mine are usually pretty hokey, but yours was great.
Okay. Well,
thank you, Tom.
Thanks, everyone. Really appreciate it.